Welcome to the third lesson in the Introduction to Valuations chapter on basic valuation metrics and the enterprise value of a business. Let's first discuss valuation metrics. Valuation metrics are ways to quantify a firm's value and put it in dollar form. For this module, we'll step back a bit and lay out some key basic financial concepts. Previously, we discussed implicit versus comparative valuation methods. In traditional finance, mathematical methods are used to find an asset's theoretical fundamental value. So for now, this content will take a purely theoretical approach. The definitions presented in this lesson are based on academic theory, which is important to understand at a basic level before we could discuss the methods actually used by investment bankers. We'll go slowly, as it's vital to understand these concepts before discussing the three main valuation techniques. First, let's introduce enterprise value. I'll usually just refer to this as EV, so whenever you hear EV, I'm talking about enterprise value. Enterprise value is simply the total value of a company. It considers the entire potential profit the company could earn in the future. In basic finance, an asset's value is always tied to its future ability to make money. That's where a company's free cash flow comes in. Free cash flow is how much money a company makes in profit after paying all its expenses. Free cash flow is essentially how much money is left available to the investors and owners of the business. Since a firm's value is tied directly to its future economic benefits, we arrive at perhaps the most important formula in all of finance. We can find the enterprise value of a business by summing up the business's future cash flows. A business is simply worth however much cash it will generate in the future. In a later module, we'll add another concept to this idea and alter it slightly, but for now, this definition works. Hammering down this concept is vital at this point. We'll use this idea in many future modules. Okay, so we're finally ready to tackle our little example on the bottom of the slide. Assume we own a factory. Now, realistically, this factory is more of a business since it will produce a certain product and sell it to customers. This is sort of a special factory or business, however, since we know that our business is going to close exactly 3 years from today. In each of those 3 years, we will know exactly how much cash our business will generate, which is our business's future free cash flows. In year 1, it will produce $30,000 of cash flow. In year 2, $50,000, and in year 3, $40,000. Based on our definition, we know precisely what our factory is worth right now. Our firm's enterprise value is simply the sum of these future free cash flows, which is equal to $30,000 plus $50,000 plus $40,000, which means our business is worth $120,000 to us right now. We will revisit this formula in a different way in future modules, but this example lays a foundation for one of the most critical concepts in all of finance. So now we are going to step out of our little academic theoretical bubble. In our example on the last slide, we knew a lot about our business. We knew exactly when and how much cash it would generate, and that it would close after 3 years of operation. Knowing or even just expecting those figures helped us calculate the theoretical enterprise value of our firm. But say we want to find the market value of our business. This means that we want to find our company's enterprise value implied by its market price. To find this value, we'll add up what's known as the market value of capital. I know that sounds a bit complicated, but let's break it down. Our factory, like most businesses, has investors. There are 2 types of investors in a company: lenders and owners. Lenders let the company borrow money with the promise that the money will be repaid in the future. Owners own part of the company and usually pay an initial investment to become a partial owner. Let's assume our factory has $40,000 in loans. This means that a bank has loaned us $40,000 and we agree to pay that amount back at some point in the future. Our factory also has $100,000 in stock or equity. This is how much us as shareholders or owners have put into the company. We add these two values together to get the market value of capital. The only step that we need to add in order to find the enterprise value of our business is to subtract any cash that the company has in its bank that is not being used to operate the company. Think of this as excess value that is not being used to generate profits for the company. We have $20,000 in excess cash. Using the market value of capital method, we calculate our firm's enterprise value by taking the amount of loans outstanding, $40,000, adding the amount of stock outstanding, $100,000, and subtracting the excess cash of $20,000, meaning that our factory is worth $120,000 to us right now. It is sort of an accident that these calculations are equal. In other words, it's an accident that using this method and the method on the previous slide yielded the same result, but we'll address that shortly. The next step to understanding enterprise value is to combine the two ideas we just covered. Let's set both EV formulas equal. We get that the sum of future free cash flows is equal to the amount of debt a company has plus the amount of equity a company has minus how much excess cash is held by the company. We'll notice here that if we can predict or calculate all but one of these unknowns, then we can find the final value. It's basic algebra. Let's pretend, for instance, that instead of calculating the value of our stock by looking at how much money we have put into the company, we want to value it based on just the true value of our business right now, the market value. To do this, we'll set the equity value, which is just the value of our ownership, equal to the future free cash flows expected by the business minus the amount of debt we have plus the extra cash held by the company. In our example, we take the sum of future free cash flows by the company minus the amount of loans outstanding plus the amount of non-operating cash in order to get the equity value we hold. That is, we take $120,000 in expected free cash flows, subtract $40,000 in loans, add $20,000 in excess cash, and get our equity value or stock to be valued at $100,000. In this formula, notice that the market value of the stock that we own is based directly on how much cash we expect our business to generate in future years. Keep this in mind as we will revisit this idea in later modules. It may take some time to understand how these formulas link together. We recommend going back through this video and listening to the examples listed a few times if you are struggling to grasp these concepts. These are the basic ideas of enterprise value. The main takeaway is that EV is a measure of a firm's total value. We can find it in two different ways: using future cash flows or using the market value of invested capital. A little hint at what's coming up. We'll continue to combine these two methods to find EV using a formal valuation technique. For now, let's move on to the final metric we'll discuss, and that is a multiple. A valuation multiple is a simplified way to show a company's worth, which is done by dividing a company's enterprise value by a measure of its current economic performance. Some metrics used to measure a company's profitability or economic performance include revenue or sales, net income, or, as we previously discussed, free cash flow. There are additional ways to measure a company's performance not discussed here. This concept can be a little confusing, but we will take it step by step. Let's look at a type of valuation multiple that uses free cash flow as the measure of performance. To find the free cash flow multiple, we take a company's enterprise value and divide it by an annual free cash flow generated by the company. Notice that unlike the previous slides, we are not adding up future free cash flows, but instead use an annual figure, which covers the amount of cash we generate in a single year. Since we calculated the enterprise value of our business to be $120,000, to find the free cash flow multiple, we could divide this figure by our year 1 expected free cash flow of $40,000. This produces a free cash flow multiple of 4x. There are a few different ways we can interpret this, but in general, what we'll say is that what this means is that our business is worth 4 times as much cash as it produces in 1 year. We'll use this basic concept to calculate valuations based on performance and valuation multiples. For now, it's critical to understand that these multiples don't directly calculate a company's value, but simply express a company's value compared to its ability to make money or generate cash. Coming up next, we'll talk about our first valuation method. Before proceeding, we encourage re-listening to these previous first 3 lessons to solidify the basics. We'll use these fundamentals to introduce a comparable company analysis, which is a comparative valuation technique that determines the value of a company by looking at a similar company.